Good evening. Welcome to our Los Angeles-based homebuyer workshop. My name is Jason Maida. Thanks for being with us tonight for our class. We're really privileged to get a chance to bring this information to you. These classes that we teach, we do these about once a week. So we have this live version, of course, that you're joining tonight, but we also do a recorded version. So, if you enjoy the information we're sharing, we'd encourage you to ask, friends, family, or coworkers if they'd like to attend. They can, of course, obviously check out some of the recorded version on YouTube. And tonight, we're going to obviously talk about home buying and kind of helping you on that path towards home ownership. So we're going to share with you a lot of hopefully great resources and support that can help you on that path. And tonight's conversation is going to be, or class is going to be kind of more of a conversation too. We have with our group tonight, we're going to have a lot of interaction with you, hopefully through the questions that you ask. We're going to answer all those questions on air as I roll through tonight's content. Just a little bit about me. Again, my name is Jason, and I get a chance to present these classes once a week. And I am a originator and actually branch manager as well with American Pacific Mortgage. We're based out of Northern California, but we service all across the country. And we basically support first-time home buyers in that path towards home ownership. So we work a lot with local assistance programs. You're going to hear a little bit more tonight about the CalHFA assistance program that can help you in home buying as well. So here's some of our talking points for tonight. We're going to talk a little bit about the housing market. What does it look like? We're going to go through a rent versus buying calculator to talk about this. Buying really makes sense for me when I kind of put together the different budgets. We'll talk about credit. We'll look at student loans and how that can impact qualifying for your home purchase. We'll look at loan programs. We'll talk about the 5 core programs for home financing. We'll talk about documentation generally needed for your home purchase. Look at assistance programs that are offered through the first-time homebuyer programs of CalHFA. And then finally, we'll wrap up tonight's discussion looking at the loan process. We call that our 6 steps of home buying, as well as what does it look like to do a personal consultation with us to help you design a home buying plan. So again, we really encourage questions as we go through tonight's content. I'll do my best to answer those questions on the air. And then at the end of tonight's class, we'll go ahead and carve out a little bit of time to review any questions that got missed. All right, well, let's go ahead and dive in. And when we think about purchasing a home, it's probably going to be one of the largest purchases you make in your upcoming financial futures. And so taking the time out tonight to learn a little bit more about what home buying can be for you, I think is a really important first step. And when we think about home buying, there's a few things that come along with owning a home and the benefits, right? So there's affordability and creating stability, I should say, with your housing budget, so you don't have to worry about maybe the landlord increasing your rent upon the renewal of a lease. This is an asset, so you have the ability to be able to potentially pass along that asset to the heirs of your estate. There's some wealth growth that is created through home ownership. And what that means is that as your home goes up in value, the difference between what your home is worth versus what you owe creates equity and obviously future wealth for you and your family. And there's still some tax benefits that are in existence with home buying. So really important things to think about when we're comparing, especially our budgets from renting versus owning a home. And so as we kind of jump into that, I want to take us through a rent versus buying calculator. And that's brought to us by Freddie Mac. And that will kind of help frame up for us a little bit about what it could look like if we continue to go down the path of renting versus what it could look like with ownership. So let's go ahead and jump into that calculator. Let me just make sure that we're good on our screen share. We're good. Okay, awesome. And okay, now we're back. All right, perfect. So, and by the way, all the tools, basically all the resources in tonight's class, we're going to send back out to you via email. So, we do have your email addresses on file, so we'll make sure that we get that information sent over to you. So what I'd like to do now is kind of build out a rent versus buy scenario for you. And I know many of us are joining us from the Southern California markets. So high cost of living area, no doubt, but we want to kind of just give us a little bit of a conversation piece with looking at this rent versus buying calculator. So let me plug in a few numbers on the fly here for us in tonight's discussion. So I'm going to just to make an assumption of say a $2,500 monthly rent. By the way, this calculator will be in the presentation that you get from us tomorrow morning, and you can just go ahead and fill in the sections or data points that are most appropriate for you with your current housing situation. So let's go ahead and just add in the $2,500 as a monthly rent. We're going to assume monthly renter's insurance of $15 a month. And then I want to make the assumption that my rent, obviously rents are going up. So we're going to go ahead and add in 3% as an expected annual rent increase. And then on the home purchase side, we're going to make the assumption of a $500,000 purchase price. I know that may sound a little bit low to many of us on the phone, but I just want to be able to kind of just give us a little bit of a baseline to work from. Now, the minimum down payment when we purchase that $500,000 is 3% of the purchase price. Okay, we're going to learn a little bit more about that when we talk about loan programs. Now, property taxes on a house valued at $500,000, we generally measure that at 1.25% of the purchase price. So I'm going to put roughly about $6,250 as the property taxes on the house. One of the things that we do as we kind of design home buying options for our clients is we're going to put together a home buying plan, and a lot of these things we talk about in this calculator will be lined up for you as we kind of meet with you for a consultation. But we're going to assume $6,250 as the property tax amount. We have homeowners insurance. What homeowners insurance is going to do is going to protect our home against any type of perils. So let's say we have, damage from fire or vandalism, your homeowners insurance would cover that. We're going to add in maintenance costs. I'm just going to go ahead and plug in, we'll say $1,000 a year. Obviously that could be more if we have maybe an older home. And then we have loan information. Of course, loan information is going to change based upon the type of product you're going to use. Now, as first-time home buyers, you're generally going to be selecting a 30-year fixed mortgage. We're going to put in the estimated interest rate for tonight's discussion. I'm going to put in 6.5% as the interest rate. And then we have origination charges. Origination charges will vary by lender. As American Pacific Mortgage goes, we do have an underwriting fee as well as a processing fee. Now, if any of you are joining us from one of our recognized partnerships across the country, we do provide a $750 discount to our clients that are part of those partnerships. We'll talk about that a little bit more in tonight's discussion. And then the next section is called discount points. Now, in this market where interest rates are a little bit higher, some clients will tend to buy points to help bring down the cost of that interest rate, because a lower interest rate obviously translates into a lower monthly payment. But that lower interest rate, it comes at a cost, and those are called discount points. Usually one discount point is 1% of your loan amount. And then 1% of that loan amount equates to just about a 0.25% reduction in interest rate. So what that means for us as buyers is if the standard rate without points is 6.5%, but I'm really trying to lower my payment and get to a 6.25%, maybe I decide to increase my costs to bring down that interest rate. So maybe, instead of having a rate at 6.5 with a certain payment, now I can pay those additional costs, bring down my rate to 6.25%, and of course, get the lower corresponding payment. Okay, so those are discount points. I'm going to go ahead and zero that out because that's not necessarily how we build home buying plans for clients, but it is an option for you as a consumer. And then other settlement services, those are going to be like title, escrow fees, sometimes transfer taxes, government recording fees. Those are what we would see under other settlement services. Now, the all-encompassing cost that we would see with that would be what we call closing costs. And those are usually an equivalent of 2 to 3% in estimated total cost. So the lender fees, title, escrow, government fees, those are all going to fall under closing costs. Now, the next tab is other assumptions. Now, we want to assume that our home hopefully will go up in value over a certain period of time. I'm going to go ahead and add in 3% just as kind of just a what if number. Now, many of our clients over the last several years have seen 8, 9, maybe 10% appreciation, but I want to be a little bit more realistic because we're looking at a certain, we want to have a conservative kind of analysis here when we look at our rent versus buying. I'm going to go ahead and assume 7 years that we're going to be in the home. Now, the cost of selling a house as a buyer, when we have a realtor that represents us, we don't pay the commissions for that realtor. However, when I turn around and sell my home, let's say 7 years from now, then I would be responsible for the realtor fees at that time. But as a buyer today, don't have to worry about paying realtor commissions. So, but we want to plug in selling costs when we eventually sell that home in 7 years. We also assume state and federal taxes and then a savings rate. So now when we look at our side-by-side comparison here, first of all, we look under payments. Now we have to know that as we design our home buying plan and compare renting versus buying, it's not going to be an apples to apples comparison, because renting right now, I'm at $2,500 a month. If I do go to home buying, then I'm jumping up to $4,200 a month. Obviously, when we're buying a $500,000 house, interest rates are a little bit higher right now. We're going to see that uptick in monthly payment. However, if we look at, a 7-year analysis of home buying versus renting, my total cost opportunity over 7 years is about $36,000 when I compare renting versus buying. How do we get to that number? Well, a couple things. One is equity in our home. So our equity goes up over time. Also, we still have tax benefits that come along with owning our house. So when we factor that into the equation, we're looking at taking that $2,500 investment in a rent, transferring that over to a $4,200 investment in a home mortgage. And that's where we get the savings of about $36,000 over 7 years. Now, as interest rates come down, or if I buy a lesser priced home, then of course that savings would improve. But there still is some opportunity with home buying, even in this current environment. Okay, now everybody's situation is a little bit different. So as we go through and design home buying plans for clients, it's really important to kind of keep those factors in mind, because that calculator is a great kind of starting point for you in deciding if homeownership is the right fit for you. Now, another thing to take into consideration is, what's the housing market doing? What are home values at? Now, housing appreciation, we've kind of talked about what that looks like in terms of homes going up in value, that equity that gets created versus what I owe on a house. But we also want to look at, where are homes valued at currently? So we're going to take a look at just the Southern California market. Median sales price is, $925,000. Our average buyer in the Southern California markets buys right around the $600,000 to $700,000 mark. And what's going on in the market right now is, homes. First of all, there's not as many homes as we'd like to see on the market. So we have an inventory challenge right now. Pretty high demand from buyers, but we have inventory challenges. And within that, there just isn't many options for buyers to choose from. Now, if you look at our slide here, we have 41 days on market, and that's saying that, the homes are staying on the market just over a month. If we were to compare that to what we saw during the pandemic, if we kind of flash back to maybe this area here where prices were up a little bit higher, we also still had inventory issues, but we had high demand, lower interest rate environment. Homes were selling super fast. Now homes are sitting a little bit longer. So even though there's a squeeze in supply right now, buyers are still being a little bit choosy in what they want to move forward with and kind of start the process on. So I think that's something we're kind of really aware of right now. And so homes are sitting a little bit longer on the market. Sellers are a little bit more apt to take price reductions on homes. They're willing to negotiate repairs of properties. So this market is definitely changing quite a bit. And I think it hasn't quite shifted to a buyer's market, but I think as we get more inventory online, and this is kind of the seasonal high peaks of the market, spring and summer buying months, we should see more inventory come available for buyers, and it will hopefully then shift or transition to more of a buyer's market. Now, interest rates are also playing a role in home buying. And so, affordability is a big part of that. We have seen interest rates start to come back a little bit more in line. Average interest rate is now right around 6.5 to 6.8, depending on the day in the market. Now, if I was to kind of pull us back a little bit, a couple of years, right in the start of the pandemic, rates reached an all-time low of 2.5%. And that really obviously fueled a lot of what was going on in the housing market. And you can see this is represented at the green axis, the blue line here, where we hit the 2.5 mark. Now, we did see interest rates from that point move up. And in 2022, we really saw interest rates start to rise. What drove a lot of that was just what was going on with inflation and the Federal Reserve ratcheting up the federal funds rate to basically try to combat inflation. Now, if we take ourselves to where we're at today in the market, interest rates are still kind of chopping around a little bit. Like I said, that 6.5 to 6.875 rate. We're really watching to see what the Federal Reserve is going to do with kind of controlling inflation. There's some thoughts that they may not raise rates next week at the Federal Reserve meeting that'll be out on Wednesday. There's, I think, last time I checked, was like a 70% chance that they'll do another raise of rates. So it really remains to be seen what happens in the market. Inflation is kind of they're delayed reporting right now in inflation. So we're seeing some signs that inflation is slowing a little bit. And maybe that may prompt the Federal Reserve to slow or taper what they're doing with the increase of rates. But we're certainly watching that because interest rates are going to play a role in affordability for our buyers. Now, what goes into an interest rate? That's a really important part of how we build home buying plans for clients, because we look at a few things. We look at credit eligibility. So the higher our credit score is, the better our potential interest rate can be. Generally, when you have at least a 740 credit score or better, then you're going to have the best available interest rates. The type of loan that you're looking at, whether that's maybe a conventional loan or an FHA loan, what your down payment is. And then we talked about it earlier. If you decide to elect discount points to buy down your interest rate, that can help lower your interest rate. And then finally, the term of your loan. So if I drop from a 30-year loan to maybe a 15-year loan, that could potentially help lower my my interest rate. Now, it's our job as a mortgage advisor for you to help design the right product that fits for you with your home buying plan. But we want to really help you understand what's going to go into the ultimate calculation of your interest rate. Now, the first component to interest rate is credit. And so as we go through our home buying class, we always like to talk about credit and how to help our buyers be more educated in credit so they can help optimize their credit when it comes to starting the journey towards home ownership. So I want to first talk about the FICO score calculation and what's made up in it. And by the way, many of our guests that come to our classes have an idea of what their credit looks like, and they're probably monitoring credit through maybe Credit Karma, Equifax, Experian, maybe TransUnion's, the tools that those agencies offer. But most of those I guess resources, if you will, are using the credit card model. Now, when it comes to applying for a mortgage or maybe a car loan, there is different scoring models that are used. So let me take you through that score calculation for mortgage. And it's right over here on the screen here. So we have 15%. It's going to be how long I've had credit. So the more mature my credit file is, the higher my credit score could potentially be. 20% is going to be how much new credit am I trying to access? So that's also known as inquiries, hard inquiries, or what we're looking at there. Also new accounts that are coming online. So if I just open up quite a few accounts, that could hurt that 20% weighting of the score calculation. 30% is going to be my credit utilization. And what we're talking about with credit utilization is my credit balances versus my credit limits. So the lower my credit utilization is, the bigger and better impact I'm going to have to my FICO score calculation. And finally, 35% is going to be how well I've paid my bills. And that's pretty easy, right? So the more on time my payments are, the better my potential credit score could be. Now, if I've had some past credit challenges, especially in the last 12 to maybe 24 months, those credit lates are going to be rated in 30-day lates, 60-day lates, and 90-day lates. So just kind of keep that in mind when we look at credit. Now, we had a question that came in, and let me just make sure that we're okay. So am I not? Let me just make sure that we're screen sharing. So it looks like somebody just mentioned that we're just only seeing the credit screen. So let me just make sure that we're screen sharing properly. Let me get back to it. Okay, so hopefully you're seeing the credit screen now. Okay, all right. So I'll make sure that we're not. Thanks for pointing that out. So great. So this is that FICO score calculation. In case other guests weren't able to see that. Again, the payment history is rated in 30, 60, and 90-day lates. Okay, so the lates that we've had in the past 12 to 24 months are going to be the most impactful to our credit score. And I'm going to share with you a little matrix here in just a second that shows you, what that looks like. Now, I want to talk a little bit about inquiries and utilization. So there's a difference in credit inquiries. There's a hard inquiry and there's a soft inquiry. Now, a hard inquiry is going to have an impact to your score. However, if you're doing applications for mortgages, for example, you have a 30-day window of time to shop around with as many mortgage lenders as you want, as long as it's in that 30-day window of time, and it's the equivalent of one credit inquiry impact to your score. Now, there's soft inquiries, which do not put any impact to your score. And our pre-approval process actually starts with a soft inquiry, so you don't have to worry about the impact to your credit score. Now, I want to give you a quick tip on managing credit utilization. So as I mentioned earlier, credit utilization is the credit balances versus your credit limits. Now, ideally, we want to keep credit utilization below 10%, 10% utilization. So what does that mean? So if I have $10,000 in limits, and let's say I want to keep my balances below $1,000, that means I'm managing down below 10%. Now, maybe you're at $6,000 in total balances, you're just over 50% utilization. Our first step would be to try to bring that utilization below 50%. And then if we're trying to optimize, get below 10%. So here's the tip I wanted to share with you. So if you look at your credit card statement tonight, check out your billing cycle date, and then obviously you have a due date on the credit card. Now, the billing cycle date is the date that the credit card issuer sends out your payment information, balance, all that to the credit bureaus. So the tip is that if you can pay off or pay down your credit balances before the end of the billing cycle date, then you're going to get a much improved credit score. So when it comes to looking at utilization, if that balance is, instead of being 6,000, is 2,000 at the end of that billing cycle date, then that's a $2,000 balance that will report out to the bureaus, hopefully give us a better credit score, and obviously improve overall qualifying. So that's just something to kind of think about. So trying to manage to your billing cycle date, it will give you a little bit more of a benefit. Now, when we think about impacts to our credit scores and potential challenges, obviously late payments are going to impact our credit score. Some of those hard inquiries will impact us. If we've had challenges like bankruptcies, short sales, those will obviously have an impact as well too. Now, account closure is something just to be mindful of, because if you're in the habit of maybe doing balance transfers to get better, maybe credit card benefits with another issuer, you want to be careful that you don't close out the old credit card that you're transferring out of, because where that can impact you is in two different areas. One is if you have a card that you had for 10 years and you open up a new card, if you close out the 10-year-old card, now you're losing all the great history that you've had. And it can impact your length of credit history. Also, if you lose that card that you've had from 10 years, and it probably is your highest credit limit amount, you can also potentially negatively impact your amount owed, because now your utilization is potentially higher because now you just lost a credit limit. So just something to keep in mind as you're trying to really optimize your credit score. And then the last thing I wanted to share with you is that how lenders look at credit scores. Now, there's 3 different credit scores from the different agencies. So there's TransUnion, Experian, and Equifax. And so as a lender, we look at that middle credit score between all 3 agencies. So here's an example. If I'm at 740 is my best score, 720 is my middle score, 700 is my lowest score, we're going to take the 720 credit score for qualifying purposes. Now, if I have a partner that's going to apply with me and my partner happens to be at 700 is the highest score, 680 the middle score, 660 the lowest score. Now we look at the lowest middle score between both borrowers. So in this case, we would look at 680 for the qualifying score. And so the last thing before we leave this topic is that every loan program is going to have a minimum credit score. So as you can see on screen, FHA loans have a minimum score of 580. Conventional loans at 620 for our VA loans and our veterans that have served that have that eligibility, minimum credit score of 620. We're going to talk a little bit more about CalHFA loans in just a minute. Those have a minimum credit score of 640. Okay, and I want to share with you just this quick little matrix. This shows you how long negative items will remain on your credit. Now, as I mentioned earlier, in the last 12 to 24 months is really where you're going to see the impact from a credit score perspective. So if I had a late payment in October of, let's say, 2022, it's kind of impacting me right now because I'm in the last 12 months of that late payment. But as I get past October of 2024, I probably should see an uptick in my credit score. All right, let's talk about student loans. And, I do realize they're in forbearance right now, just as part of the CARES Act. But we still have to count student loans in the qualifying for home financing. And I think student loans are going to start coming online for payments in September. And so right now we'll take your income-based repayment amount that you had prior to the pandemic. So that's whatever amount that might be. Now, that's the income-based repayment amount. Now, if you graduated during the pandemic, you haven't started payments yet. So, generally what we'll use as just a starting point as either you'll get a calculation from your student loan servicer that says, hey, this is what your expected IBR payment is going to be, or we'll use 1% of the total balances on a conventional loan, 0.5% of the balances for an FHA loan. So let me show you an example of that. So if I have $75,000 in student loan debt and I have an income-based repayment amount that I signed up for prior to the pandemic, then I'm going to use that $250 monthly payment. Now, if I don't have that IBR payment, that's when we would default to using 0.5% of the balance or 1% on a conventional loan for the monthly payment. So some student loans will have even 0 payments as part of the income-based repayment. And if that's the amount that's owed, then that's the amount we'll use. But most student loan payments right now, because of the deferment or forbearance, don't show as a monthly payment at all on the credit bureaus. And so that's why we have to have a monthly payment added for the calculations. Now, if you're back in school, you're probably on deferment. We'll still have to count a monthly payment against the qualifying. If you like I said, graduated during the pandemic, then we'll have to kind of do the calculation to figure out what your expected payment is going to be. And most of our clients do have student loans, so it's something we're going to have to kind of go through as part of our building our home buying plan. So we just want to make sure that you understand how we come up with that calculation. Now, those guidelines for student loans come into play with different loan programs that are offered. So I want to spend some time now looking at different loan programs. These are the 5 kind of core programs that are available to our buyers. And we're going to spend most of our time tonight talking about conventional and FHA loans, but I want to kind of give you just a little bit of the characteristics of each one of these products. So the conventional loan is a minimum down payment of 3% up to a loan amount of $726,000. And that's what we call the conforming limit. That stretches across the entire nation. However, there are high cost areas, especially in California, Southern California, as many of you know. And so the high cost of living areas allow us to stretch that loan amount up to $1,889,000. And so that allows us a little bit more flexibility in qualifying our clients. Now, when we have to finance more than $726,000, the minimum down payment goes from 3% to 5%, specific to a conventional loan. So when you think about conventional loans, those are Fannie Mae, Freddie Mac type loans. So you may have heard that in your online search or just in the news. So Fannie Mae and Freddie Mac originate about 70% of all mortgages in the country. So that's a big part of what we do. Now, the FHA loan has a minimum down payment of 3.5%. Now, there is no differential between loan amounts and corresponding down payment. So you have a full 3.5% down payment on an FHA loan. A lot of clients think that FHA loans are for first-time buyers only. It can be, and it's not the case. It can be for second and third-time buyers. FHA stands for the Federal Housing Administration. So it's a government-backed product. We're going to spend some time in just a minute talking about the differences between a conventional loan and an FHA loan as it relates to mortgage insurance. And then our VA loans are going to be for our veterans that have served and they have an eligibility for the program. One of the great things about these products is that it has a 0 down payment option. And for most of our veterans that are eligible for this product, there will be a funding fee. That funding fee is usually 2.3% of the loan amount for first-time users. And that in some cases can be waived if they have eligibility as an exemption. I'm sorry. We have USDA loans. Those are going to be for our clients that are looking to buy in more rural areas. So, if you're looking maybe to purchase in Joshua Tree, that would be considered USDA. USDA has, kind of 2 key components to it. It has geographical requirements, like I mentioned. Then it also has income limitations. And those income limitations are based upon the household size and the income for that family in the expected home. And then jumbo loans are going to be for our clients that need to purchase a little bit more of a home. Maybe they need to finance more than the $1,889,000 number. Jumbo loans aren't typical for our first-time buyers, but jumbo loans generally have a minimum down payment of 10 to 15%. Now, when we think about home buying and the asset or down payment requirements that you need to fulfill, jumbo loans are a little bit different because in standard financing, we need our down payment saved as well as our closing costs. So you've already learned that the minimum down payment is 3% plus your closing costs, which can be on average of 2 to 3% of your sales price. But with jumbo loans, we also have what we call as a reserve requirement. And what reserves mean is that there are additional funds that I have available to me that can be in my bank account, brokerage account, 401k, 403b. whatever the case may be, but there are additional assets that I have left behind after I've contributed the down payment and the closing costs. Usually a reserve amount is going to be the equivalent of 12 months of my monthly payment for my mortgage. So if my mortgage payment is $6,000 a month, it's a 12-month requirement. That means I need an additional $72,000 in assets after I've contributed the down payment as well as the closing costs. Now, PMI is where FHA and conventional loans can differ quite a bit. And, it's our job to obviously design the right home buying plan here for you, taking into consideration the features and benefits of each one of these programs. But I want to kind of look a little closer at PMI, because when I talk to clients throughout the day, many of which start their searches for homes on Zillow or Redfin, some of the calculators don't necessarily kind of add up to what an actual payment amount is going to look like for a buyer. So it's really helpful when we kind of go through this during our home buying classes. So, how does conventional mortgage insurance work, first of all? So there's different payment options for conventional MI. You can pay it monthly. You can pay it as what we call a split MI, where you pay some of it up front, pay some of it on a monthly basis. There's what we call single premium, where you completely buy out the mortgage insurance. And then there's lender paid mortgage insurance. And how that works is you're actually taking and building the cost of that mortgage insurance into the interest rate. And it honestly doesn't happen a lot, especially in this high rate environment today. So if the rate was 6.5%, maybe I elect a 7% rate to help buy out the mortgage insurance. Now, there's a few different factors that make up what I'm going to pay for PMI. It's going to be what my credit score is, how much I'm going to finance, and then what my down payment is. So like I said, a lot of those calculators don't necessarily calibrate that into those calculations that you're receiving. So that's really important to understand when, we're kind of looking at different budget options for you. Now, on conventional loans, there is a cancellation option where once you have 2 years in that original loan and 20 to 22% equity, you can apply to have the mortgage insurance canceled. And that's one of the big benefits of a conventional loan. Now, let's take a look at an example of what PMI might look like on a conventional loan. So let's say you have an amount financed of $700,000, you have a credit score of 740, and then you're looking to put the minimum down payment of 3%. Now that PMI is going to add up to about $209 a month. So, relative to the amount financed, and because I'm a higher credit score customer, that 209 is a little bit more manageable. Now, if I was to look at the same PMI scenario with FHA, let's talk about FHA PMI first, and then we can look at the scenario. On an FHA loan, when I look at PMI, there's a couple different components to MI. One is there's monthly MI on FHA, which is 0.55% of my loan amount. But then there's also upfront mortgage insurance, which is 1.75% of my loan amount. Now that 1.75% gets added into my amount financed, doesn't impact my out-of-pocket expense, but it does elevate how much I'm borrowing. Now with FHA mortgage insurance, there's not a cancellation option. So the only way to be able to exit mortgage insurance with FHA loan is to be able to refinance into a different product, which would be like a conventional loan. So if you took the same example of a $700,000 loan, here's what it looks like on FHA, on the FHA side. So I have my monthly PMI, which is now a little bit higher. It's $320 a month, but then I have upfront mortgage insurance. So it's $12,250 that gets added into my amount financed. So instead of just financing $700,000, I'm actually financing $712,250. So that's kind of where FHA and conventional loans are going to differ when it comes to PMI. Now, you may kind of be hearing this information and say, well, why would I ever go FHA? Because it's clearly a lot more expensive than a conventional loan. And, you're probably right. But at the end of the day, what we need to look at is kind of the different qualifying parameters for each one of these products, because conventional loans are going to look at our borrower's financial profile a little bit differently than FHA, because there's different guidelines that each one of these products have. So for example, a conventional loan has a minimum credit score of 620, where FHA is 580. Maybe I had a couple lates on my credit cards over the last year or 2 years. Conventional might be a little more challenging to get qualified having those past lates, where FHA will have a little more leniency. Or let's say I had a bankruptcy 3 years ago. FHA, completely okay, but conventional requires at least 4 years out of a Chapter 7 bankruptcy. So some of those different nuances in the guidelines will lend for a buyer to look at one product over the other. And again, this is part of how we build home buying plans for our clients, figuring out what's the best product to help meet your home buying goals and objectives. Now, there's some documentation that's required in home buying. And so I want to kind of share with you that really quickly, and then we'll start kind of talking a little bit more about income qualifying. So here's some of the documentation for a W-2 wage earner. So we're generally going to need the last 2 years of W-2s, last 30 days of pay stubs. We do complete verifications of employment during the process, not necessarily at the pre-approval stage, but as we go in through the escrow phase, we'll be verifying employment. Now, if I'm self-employed, we'll generally need the last 2 years of taxes, a profit and loss statement, and then some type of way of verifying the business, whether that's through a CPA letter, maybe it's through like online verification metrics or methods. So those are all ways that we can verify self-employed individuals. Now, it's going to be a little bit more documentation required for self-employed individuals, and it just depends on ultimately what their tax structure looks like. Now, let's talk a little bit about kind of some of the income requirements, but more so the employment situation for some of our buyers. There is some misconceptions out there that some of our buyers need to have 2 years in their job to be able to be eligible for financing, which just really isn't the case. You can actually, and let me give you an example I share with a lot of our alumni groups we work with. So let's say I'm getting ready to graduate in the spring of next year. Actually, let's say the fall of this coming year. And I have 4 years in undergrad, and now I'm getting ready to start my my full-time career job later on this year, and it's going to be in accounting, right? Well, I've had a 4-year accounting degree, and now I'm going into an accounting field. So actually, I don't need to have 2 years on that job. I can use my education that's supporting my job to be able to meet that 2-year requirement. So we don't necessarily need to have a full 2 years on the job. We can use education as supporting for the 2-year requirement. Now, we do need to see 2 years of job history. So we don't, we could have 1 month on our job, and maybe I was working for another position over the last 23 months. That still satisfies the 2-year requirement. Now, when it comes to multiple employment sources, and we see this a lot in the healthcare industry. So let's say I'm working for one healthcare clinic for 30 hours a week, and I have 20 hours for another position. Now I'm working 50 hours a week. As long as I can show that I've been on both jobs for 2 years, simultaneously working that type of schedule, then that would qualify me to be able to use both sources of income. In some cases, we do have buyers that are transitioning to jobs. So maybe I'm working for maybe a state job right now, and I have a job available to me in the private sector, and I have an executed offer letter. As long as I can get proof of that new offer letter for the new employer, then we could potentially use that for qualifying. Now, for self-employed individuals, we do generally need to have at least 2 years of having the business to be able to use that income for eligibility. If I have dual employment where I'm, let's say, working as W-2 wage earner, and I also drive for Uber or Lyft on the side, I can still use both sources, but I have to be able to show that I've been at least working that Uber or Lyft position for 2 years simultaneously with my W-2 wage earner job. Okay, now I know I didn't ask for any questions, but income gets a little bit complicated at times. And so I don't know if there's any scenarios our audience has that maybe we can answer on air here. And we haven't had many questions tonight, but I want to make sure that we carve out some time to be able to do that. So feel free to use the chat function if you do have some questions. Now, I do want to kind of talk with you a little bit about a calculation called debt to income ratio, and it helps us determine qualifying for our buyers. Now, this doesn't necessarily indicate affordability, because affordability is going to be a conversation we have that as we go through your monthly expenses and the expected housing payment, what's going to be affordable for us. But debt to income ratio looks at qualifying of your gross monthly income versus your outgoing expenses, including your new mortgage with the property taxes, insurance, mortgage insurance, if applicable, homeowners insurance, and takes a look at that payment total, as well as your car loan, personal loan, credit card, whatever other expenses you have, and compares the gross monthly income versus those expenses. Generally, we don't want those expenses to occupy more than 45% of your income. Now, that looks a little bit different for every individual, because 45%, keep in mind, that's pre-tax number. So that's not necessarily a representation of what you're netting in income every month. So we want to be really mindful of that. So lenders can do 45% of the gross monthly income in total expenses, as high as 50%. And that obviously varies for different loan calculations. Here's what the debt to income ratio calculation looks like. So it's the principal and interest, the taxes and insurance, as well as PMI if applicable for the mortgage, HOA expenses, which is the homeowners association dues. We see these a lot in more of our condo communities, townhouses. And let's assume a mortgage payment totaled up to $2,500 a month. And then we have other debts of $500 a month. So now we're looking at total outgoing expenses of $3,000 a month. And let's say my income was $8,500 a month. When we look at the debt to income ratio, it takes that $3,000 a month divided by my $8,500 in pre-tax income and puts my debt to income ratio at 35.29%, which for most of our first-time buyers, the sweet spot, so to speak, is 33 to 36%. So that's right there. Even though we can still qualify at 45%, a lot of our buyers feel pretty comfortable when we're in that 33 to 36% range. Okay, so the last stop that we're going to go through in tonight's discussion around building our home buying plan is going to be around, the asset requirements that are needed for home buying. You heard us talk a little bit about, savings for down payment and closing costs. Now let's just talk really quickly about some of the documentation, and then we're going to spend some time looking at assistance programs to help with the assets for down payment and closing costs. So the documentation's pretty simple. We generally want to verify the last 60 days of statements for whatever account we're going to use, checking and savings accounts. Now, cash deposits can't be used in funds for home purchasing. We do have to track every deposit that goes through a bank account. 401ks, 403bs, even IRAs can be used. I would just encourage you to talk to your tax advisor, your financial advisor, making sure that you don't have any type of tax event that would be incurred by using some of those assets. Now, gift funds can be used for your home purchase, and gift funds are where a family member helps out with the home purchase. Now, gift funds don't require any type of seasoning of the asset. Most assets require 60 days, but a family member can help out right away. How we document that is through a gift letter that the family member completes. We have a template that's available that we'll share with them. Well, they also show us proof of the transfer of funds. Generally, we recommend that the donor transfers funds directly to what we call as escrow. All right, so that's kind of what assets look like for home buying. And when I think about home buying for our first-time buyers, there's usually kind of two things that get in the way from home purchasing. It's credit, because maybe we're just maybe a little bit overextended or we've had some past challenges. But more often than not, it's just lack of savings. And we understand in today's market where things are much more expensive, it's a little bit more difficult to save. And so in these classes, we always like to talk about first-time homebuyer programs, and we're really privileged and grateful to be able to partner with CalHFA, which is the California Housing Finance Agency, and their mission is to create sustainable home ownership for low and moderate income households. So tonight, I want to kind of now share with you a little bit about some of the assistance programs that are available to you. We're grateful to be the leading provider of these programs, and so if this is something that you're interested in as part of designing a home buying plan for you, we'll include the assistance programs that are available. So let's talk about a few of those, and I'll give you some examples of kind of real application to these products. So the first one is the MyHome Assistance Program. And the MyHome Assistance Program can help fill the void for the minimum down payment amount for a conventional loan or an FHA loan. So the conventional loan provides up to 3% of the sales price in assistance. So that'll actually cover the minimum down payment. It'll be 3.5% for an FHA loan or any other type of government products like VA or USDA products. What that is, it's a low interest rate loan at 1% interest. And what's cool about it is you don't have to actually pay back that assistance until you either decide to sell the home or if you refinance in the future. So that's called the MyHome Assistance Program. And it works with conventional loans, FHA loans, VA, and the USDA loans that we shared with you a little bit earlier tonight. Now, if you need a little bit more help beyond down payment assistance, there's also closing cost assistance, and that's offered through the ZIP Assistance Program. It's anywhere between 2% to 3% of your loan amount. And what it is, it's a no interest rate loan that's also paid back when you either sell the home or if you refinance in the future. Now, that is a 0% interest rate loan. Now, the way it works with CalHFA is we first have to take advantage of the MyHome Assistance Program. Once we fulfill that need, then if we need additional support, then we can add on the ZIP Assistance Program. In today's market where interest rates are a little bit higher, the ZIP Assistance Program doesn't always make sense for our buyers. So as we design home buying plans and pre-approved clients, we recommend probably only using the MyHome Assistance Program right now to be able to keep that interest rate down to an acceptable level that's going to make home buying as affordable as possible. Now, I want to show you guys what an example of using this product as a conventional loan would look like versus maybe traditionally what a regular conventional loan could be. So if I bought that same $700,000 house, we know the minimum down payment is 3%, right? And then we have those closing costs, which are anywhere between 2 to 3% of my sales price. So for the most part, I'm probably going to need about $35,000 to $42,000 to be able to purchase my home. Now, as many home buyers as we help throughout the year, hundreds of home buyers, it's really difficult to save that much money for most of our first-time buyers. And most of our first-time buyers have maybe $8,000 to $15,000 in available assets. Now, where CalHFA comes and helps fill the void is that if we still want to buy that $700,000 house, we can take the MyHome Assistance Program, apply the $21,000 in low interest rate assistance to help cover that down payment amount. And then as a first-time buyer, all we're really kind of focusing in on is now saving enough money for those closing costs, which we said were anywhere between $14,000 to $21,000 in our example. Now, if we still need additional help to be able to help close the gap for out-of-pocket, then we can also add in that ZIP assistance of 2 to 3% of our loan amount in additional support. So that's how we design plans for first-time buyers. And it's a great opportunity to help make homeownership just a little bit more of a near-term goal. Many of our clients that we talk with are on 1 to 2 year plans, but now when we incorporate the CalHFA program, makes it maybe more of a 3 to 6 month goal for achieving homeownership. Now, there is some eligibility requirements for the first-time buyer program. For an FHA loan, it's a minimum credit score of 640. For a conventional loan, it's a 680 credit score. Now, if we're considered what we call low-income housing, which is 80% or less of the median income, then the minimum credit score is 660 for a conventional loan. The maximum debt to income ratio standard is 45%. On exception, we can go up to 50%. And the income qualifications are a little bit different than most first-time buyer programs because we look at the applicant income versus the total household income. Where that plays a role is because some of our clients with combined income, so if my partner and I make combined income that exceeds the income limits for the program, potentially myself could maybe apply in just my income. So let me give you an example. For example, in LA County, the maximum income limit is $180,000. Now, if I earn $100,000 as an individual, but my spouse also earns $100,000 a year, my total income is $200,000. Now, that would put us outside of the CalHFA income limits. However, if I applied just in my name, then we could just use my income for qualifying and still be eligible for the assistance. So that's a way that you can still get access to the funds, because most first-time buyer programs, especially for local city or county programs, will look at total household income, where the state just looks at applicant income. And a first-time buyer is someone that hasn't owned in the last 3 years. So I talk to clients all the time and they say, well, I owned back in 2010, so I'm not eligible for first-time buyer programs, which is just not the case. So if we haven't owned in the last 3 years, we're still now considered a first-time buyer. And these products are eligible for single-family homes, condos, townhouses, even some of the below market homes that are offered throughout the state of California. Manufactured homes are eligible, but they can be a little more complicated because they have to be on land that's owned. So you can't purchase a manufactured home like in a mobile park or anything like that. Here's the income limits that are available right now with CalHFA. Now, these income limits are going to get updated on June 12th, so that's just next week. But here's what they look like in the Southern California markets. My sense is they're probably going to go up next week just because of the cost of living adjustments. So we should see those income limits start to increase a bit, especially in LA County market. That tends to be a little bit lower than some of the bordering counties in Southern California. Okay, so let's talk a little bit about what's this process look like. So as we're going through tonight's class, you've heard about how we build home buying plans for clients, understanding more about credit and about products and income and assets and all the ingredients that go into building a home buying plan. But now I want to kind of take you through what's the process look like. So the first step in home buying is going to be for the pre-approval. And the pre-approval is the output of a consultation with us. And that's about a 30 to 45 minute session. A pre-approval is a certificate that you receive as a buyer that you can present to a seller that says that you're eligible for your financing and you're eligible to purchase this property. Usually the pre-approval is good for 60 days, but we can always recertify it if your home search takes a little bit longer for you. And step 2 is the home search. That's the house hunting. So that's where you get a chance to partner with a realtor. We encourage you to work with a realtor. And as you heard earlier, realtors are paid for by the seller. So we always encourage you to take advantage of that resource. The home shopping or house hunting can take anywhere between 2 weeks, could take 2 or 3 years. Just depends on, where you want to be. On average, we see most of our first-time buyers taking about 3 to 6 months. But we can update that pre-approval for you at any time. So if you're looking at a lower priced home, or maybe you want to try to qualify for a higher priced home, we can always amend that pre-approval to match your offer price. Now, if we're kind of going through the house hunting phase, we finally found that house that we love. We make an offer on that house. Now we present that offer to the seller and then they accept that offer. And by the way, that acceptance of offer may not come on the first house that you find. It may take 2 or 3 times to be able to actually get an accepted offer. But let's say that does happen on the first try. Now we're going to enter escrow. So that means the seller has accepted the offer to our house. And our responsibility as a buyer is to provide an earnest money deposit within 2 to 3 days of that accepted offer. Usually the earnest money deposit is 1 to 2% of your sales price. Now, we're going to talk more about that in just a second, but that is your good faith investment into that home purchase. Now, our team's going to reach out to you within 24 hours of that accepted offer, because what we want to do is schedule you for your follow-up consultation. So we can get a chance to spend some time with you to talk about your interest rate options, how we're going to recommend setting up your loan program, what your out-of-pocket expense looks like. And within about 72 hours of your accepted offer, we're going to issue to you your initial disclosures for your loan. We're also starting the ordering process of verifications and your appraisal. Your realtor is going to help you order an inspection of your home because we want to make sure that we do all our homework on the property. And as I mentioned, you have that earnest money deposit, and this is a slide that kind of shares with you a little bit more of what an earnest money deposit is. So it's your good faith deposit to the transaction that shows that you have a financial interest in making this work. And it's usually 1 to 2% of your sales price. Now, that deposit is protected through what we call as the contingencies. And the contingencies is basically a protection for you as a buyer. It gives you usually 14 to 17 days timeline to be able to do your homework on the property, get the house appraised, get your house inspected, and ultimately get your loan approved. Now, if something was to happen where something just didn't add up on your appraisal or your loan approval, or maybe the inspections, you do have the ability to be able to cancel and be able to get a full refund of your deposit. So it's a really important protection as a buyer. Step 4 is processing and underwriting of your loan. That's where our team verifies, some of your income, your assets, kind of gets all the product designed and ready to go so the underwriters can complete their approval of the loan. And that happens at step 5. So at step 5, we have a loan approval. We're now about 3/4 of the way through the process. And at that time, now that you'll have your loan approval, you'll have your appraisal back, and your inspections are done. So if you feel comfortable with the property after doing all that homework, then you're going to remove your contingency. That tells the seller that you're now ready to remove to the closing phase of the process, right? We're also going to issue to you a final closing disclosure. And that final closing disclosure is going to give you a 3-day cooling off period just to make sure all the numbers line up to what you expected and what you've seen in the previous milestones. And now we're going to get to step 6, which is the closing of the loan. That's where you get a chance to sign final documents with the public notary. That takes about an hour to maybe 90 minutes of your time. After that's been completed, then you're going to wire in your final funds for closing of the home loan. That money gets reconciled by an escrow team. At the same time, our team is going to make sure that we've got all the documents signed correctly. If that all checks out, then the funds are wired in for both the first mortgage, any assistance programs that you're going to elect as part of your home buying. And then once that money gets all balanced out by the escrow team, they'll release the documents to the county recorder's office to record a grant deed, and that transfers ownership to you. And they also record a deed of trust, which is your agreement to repay the loan. And guess what? Once all those items get confirmed as recorded with the county, then you become the official owner of the home. And that's a really exciting time. That's probably the most enjoyable thing that I have in the process, is getting a chance to call our first-time buyer that's successfully navigated through the process and now gets a chance to get the keys to their homes. Because, this is going to be one of the largest investments you make in your financial futures. And so we want to celebrate with you. And we're right there every step of the way. One thing I want to just make as a side note, On the first-time buyer programs, there is education that's required on those programs. Those are that's one of the things that you'll be doing as part of your home buying process. There's usually 8 hours of online education for the first-time buyer programs. Now, if you're looking to take the next steps in home ownership and want us to help you design a home buying plan for you, here's the steps to move forward. We call it our Get Started information. So there's a real simple online application that you complete. Again, we only start with a soft credit check. You also upload proof of your income and asset documentation to that application. Once that's all done, then we'll get a chance to meet with you for a video consultation to help design that home buying plan for you. And I think that's a really important step in just trying to figure out what your goals, maybe your objectives look like for home buying. And that's a one-on-one conversation that you'll have with me. Now, after leaving tonight's class, maybe you have some questions that didn't get answered on air or you didn't get a chance to ask them in tonight's presentation. Feel free to set up an introductory call with myself or one of our colleagues, and we'll make sure that we get those questions answered for you. Here's what a consultation looks like. Here's the basic framework of a consultation. And, we're looking at, where do I want to buy? What's my budget look like? What can I do to optimize my credit? What are my different interest rate options, out-of-pocket expense? We want to make sure that you understand what the total kind of setup is going to look like for your home buying plan. And we have some great resources that are available to you, including our mobile app that's available for Android and Apple. It has a calculator built into it. Also, we'll start pushing notifications to you as you reach those different milestones in the process. And just a really helpful tool on this journey towards home ownership. Now, you may have found out about our classes through our wonderful community partnerships across the country. We're happy to partner with all these wonderful organizations. And if you're part of some of these alumni groups, or maybe even a state employee here in California, we offer discounts in closing costs for those organizations. So really proud of all the partnerships that we have. And, we understand taking time out on your busy Wednesday night is not the easiest thing, but we really appreciate your investment and time with us to be able to learn a little bit more about home ownership. And we love what, past clients are saying about us in our reviews and their experiences with us, many of which those past clients have come right from the classes right here that you're attending tonight. We've been teaching classes over the last 7 to 8 years all across our communities that we serve. And so we're really proud of what our clients are saying about us. And we try to put out good, useful content in our social channels like Instagram. So whether there's new assistance programs that are coming online, new classes that are available, or a different tool or resource that's available to you, we would really encourage you to kind of check us out and follow some of our social channels like Instagram. Here's all of my personal contact information. So if you want to get connected with me after tonight's class, feel free to reach out to me, call, text, email. Love to be able to meet you and see how we can best help you. So that kind of brings us to the end of tonight's class. I know we haven't had a lot of questions in tonight's class, but I want to make sure that we stick around, answer anything that maybe one of our guests have. And if we can get those answered on air, of course, we can follow up with you if you have any questions that you want to ask off air. So I'll go ahead and open it up for any questions that you may have. Okay, I think we're good. Okay, well, again, if you have any follow-up items that you want to chat with me about, feel free to reach out. I do appreciate everyone joining tonight's class. For any details on future classes, you can check out mortgageeducate.com, and we'd love to be able to see you at a future class. Have a wonderful evening. We'll talk to you soon.